Welcome, everybody. I'm going to wait a couple minutes here and we will get rocking and rolling. Let everyone sign in and we'll get going from there. So let's get this baby humming. We'll give everyone a couple more minutes to log in and we will get rocking and rolling. All right. All right. It's been a couple minutes, so we're going to go ahead and get started. I am Travis Egan. You'll see my cursor. Forgive me if I look off on the other screen. So we're going to be talking about utilizing your hard-earned VA loan benefits, what they don't want you to know, right? Like what don't they want you to know about your VA home loan benefit that you've deserved. So let's kind of get rolling through here. Why should you listen to me? My name is Travis Egan. I am the VA mortgage vet. I'm a United States Marine combat veteran. I deployed to Panama for a couple of years right after Operation Just Cause, also to Bosnia, in Operation Deliberate Force. I work for Edge Home Finance. I've been doing mortgages since about 1995. I've done well over 4,000 mortgages in my career. I am a founding member of the Veteran Mortgage Corps. I'm a veteran housing advisor and a veteran mortgage advisor. I haven't seen everything, but I've seen a lot of things. So I don't pretend to know everything. So if you have questions or concerns, by all means, please reach out and let me know. But we will keep cranking. So what are the objectives that we're going to work on today? So let's talk about these. What are the mission objectives for this evening? We're going to talk about who you work with matters. So why is it important you work with the right professionals as you go through this process? We're going to talk about QR codes. Throughout the presentation, there will be QR codes. There will be opportunities for you to get specific pieces of information. So if you're watching this on your computer, you can put your phone up to it and get that QR code and get the information, little pieces of information that will be beneficial to you in this process. We're going to find out if you're eligible for a VA loan. So what does that mean? Are you eligible? Yes or no? How does that look? So we'll talk about that. What's the difference between a pre-qual and a pre-approval? We'll do some myth busting throughout. So there'll be opportunities for things that I've run into in my career, things that I hear from loan officers, things that I hear from other realtors that let me know that we may want to address in this topic. We'll talk about your next steps. So once you've finished this webinar, you're going to know, do you qualify or what does it take to qualify? Who you work with, why it matters, why you should get pre-approved versus pre-qualified. We're going to bust some myths and we're going to tell you your next steps to go ahead and get you into your dream home. And then there'll be questions throughout the seminar as we go through here. And when I get to the question section, I'll let you know, I'm just going to ask you to type the answers in the chat if you don't mind. So what's my personal mission statement? My mission is to help veterans and service members own a piece of the American dream that they fought for. My goal is to educate consumers, real estate agents, and the community about the strength of the VA home loan. So that's my personal mission. That's my business mission and what I do every day. So what is a VA home loan? So a VA home loan is nothing more than a mortgage that's guaranteed by the U.S. Department of Veterans Affairs and issued by a private lender, like a bank, a credit union, or a mortgage company. So the Veterans Administration basically sets the rules and they insure the loan. They make sure that it's insured. So as long as you meet their criteria and you meet your eligibility standpoint, that's what a VA mortgage is all about. So what are the benefits? Let's talk about benefits of the VA home loan. First is it's 100% plus financing. Now, I'll get into the plus financing in a moment, but just know that means no money down. You won't need any money for down payment in the process. There's no private mortgage insurance like there is on FHA, USDA, or conventional mortgages. Those mortgages all have some form of mortgage insurance if you don't put down at least 20% on the transaction. And then, as of January 1st, 2020, with the Blue Water Navy bill, uh, there is no loan limit. So if you can qualify for a $5 million mortgage, you can get a $5 million mortgage on a property. So there is no minimum. You can do that with 100% financing. Huge advantage for veterans, especially veterans or active duty service members that are buying in high cost areas. So if you're buying in an area that, say, Hawaii or California or parts of Nashville area, those places tend to be more expensive. And when those places are, some of the places in Florida, for instance, all of those things will allow you to get 100% financing. So that's pretty spectacular. And then obviously, one of the things that I talk about quite often is on VA mortgages, the interest rates tend to be lower than they are on conventional loans. That's why you should at least consider it. So how do you qualify? Right? So say you're a service member or a National Guard member or a veteran. You've served in our military at some point. So the definition of how you become eligible is a veteran is eligible for a VA home loan if he or she has served on active duty in the Army, Navy, Air Force, Marine Corps, or Coast Guard after September 15th, 1940, and discharged under conditions other than a dishonorable after either. So basically, when this was put into place, the Space Force didn't exist, right? So they would effectively be accounted in this as well. So when you're serving on active duty for a period of 90 days or more, during any part of which occurred during wartime. So in the last 20 years, we've been at war. So pretty much if you served on active duty for 90 days during that time frame, you're eligible. If you served on active duty for a period of 181 days during peacetime. So if it was at a time where we weren't at war somewhere, then it would be you had to serve 181 days. And then you served on active duty under Title 10 or Title 32 orders for a period of 90 days, with at least 30 of them being consecutive. So this is a lot for reservists, National Guard members who get called up, which are your Title 10 and your Title 32 orders. And then if you're in the National Guard and you served, or reserves, and you served 6 good years in the National Guard with 16 points and you've received an honorable discharge, you would be eligible for a VA loan. Now, here's your first question. And go ahead and put your answers in there. I promise I won't delay this too long. So, do you need a COE to qualify? A COE is the certificate of eligibility. So, do you need that? Go ahead and put your answers in the chat and let me know. I'm not, like I said, I won't hold this up too awful long, but the answer is yes. You absolutely have to have a certificate of eligibility to qualify. That is one of the pieces of information that we need for eligibility. So what is the certificate of eligibility? You'll hear me refer to it as the COE throughout the presentation. Just want you to know the COE is the certificate of eligibility. So it's a document that comes directly from the VA, and it confirms your eligibility for a VA home loan. It's obtainable through e-benefits or directly from the lender. On a slide coming up, I'll show you how to get it for yourself. Whether your lender can get it for you or you can get it for yourself. If you choose to get it for yourself, I'll make it easy for you to do so. What are the documents that you need to obtain the certificate of eligibility? So if you don't do it through your lender and you're doing it on your own, these are some things you'll need. So if you're an active duty service member, you're going to need your statement of service and your current orders. If you're a veteran, you're going to need your DD-214. Or if you're a reservist who's served on active duty, you're going to need a DD-214. that met the criteria on the previous slide. A National Guard, you're going to need your NGB 22 or your NGB 23. And then reserve statement. So if you're in the reserves, you're going to need a statement of service and your point statement. So these, depending on what you qualify as, these are the documentation you will need to get your certificate of eligibility. What does the certificate of eligibility look like? So it looks like this document right here in the middle. So I created a URL shortener. If you go to vamortgagevet.com/COE, it's going to take you to your to the VA so you can apply to get your certificate of eligibility. If you take your phone and you hold it up over that QR code over here on this right-hand side over here, if you hold your phone up over the QR code, that will also take you to it, and you can bookmark the site. This is right where you would go. You'll have to create a login and password if you haven't already, and this is where you can apply for your certificate of eligibility. If you look on here, we've blocked out a lot of the customers' names, so you won't know who they are, but it just shows this entitlement code, your military branch, do you have to pay the funding fee or not, and then this will list all of your mortgages that you have. And then it'll also tell us how much of entitlement that you're entitled to, right? So we'll go into entitlement and what all that looks like. But this is the document your lender will use to determine, one, are you eligible, right? Are you eligible? The first thing we have to answer on a VA mortgage is eligibility, then qualification, right? So we want to make sure you're eligible first and foremost. So now let me ask you, do you believe there's a difference between pre-qual or pre-qualification and pre-approval? I hear these terms used synonymously in my career. I've heard realtors use them the same. They are not the same. So is there a difference? The answer is, shockingly, yes, there is it's a huge difference. So let's talk about that. What is the difference between a pre-approval versus a pre-qualification? So a pre-qualification is basically, it's a preliminary step where the lender estimates the potential loan amount based on basic financial information you provide. That could be over the phone, that could be over the internet. They're basically taking what you tell them at face value and determining what your eligibility, what you would qualify for. So understand that is just, it's like any other type of program. The more accurate the information that goes in, the more accurate the information you'll get back. So pre-approval, on the other hand, is a formal step where the lender verifies your financial information and creditworthiness and then provides a letter stating the specific loan amount to which you qualify for, indicating to the seller that you're a serious buyer. We go through and we underwrite it. We verify your income. We verify your assets. We verify your down payment and closing cost money. We verify everything that we possibly can on the front end. So that way, when you and your spouse, you and your family find the home that you want to buy, you're able to do that. You're effectively a cash buyer, as close to being a cash buyer as you can be. Now, I will say this is a huge, huge, huge deal. So please hear me when I say this. If your lender issues you a pre-qualification or a pre-approval letter and they have not pulled your COE, they don't have it in hand, run. I share this with you to say I have had several calls in the last 6 months from other lenders and from realtors who call me and say, hey, we tried to get this loan done VA. We can't do it VA because they're not eligible. Please, please, please make sure your lender has that certificate of eligibility up front. Luckily, we were able to save most of those, but a few of those we could not help, and they weren't able to get the home that they were looking for. So please don't put yourself in that situation. So if you're the buyer, at some point, you're going to be a seller, right? You're going to be a seller. So you're going to own a home, and at some point, you're going to be the person selling that home, whether you're moving up to a newer home, building a home, selling down to a smaller home. So why should a seller accept an offer from a VA offer, right? The key here, so remember one of the things I said in the very beginning, which is who you work with matters. The presentation of your offer from the buyer agent, it's everything in this transaction. It is critical that you work with an agent who understands the VA loan program and understands the VA loan process. So I like to reach out to the listing agent and let them know information that doesn't violate financial privacy, but does let them know that we've verified and vetted your ability to qualify for this loan. But that doesn't always happen. Sometimes I don't get that opportunity. So I want you to know that hiring the right agent is critically important. It's almost as important. Heck, I would say it's probably more important than hiring the right lender. Truthfully, it's that important. Um, so on VA mortgages, the underwriting's easier. If the underwriting's easier, that means the qualifications are easier. On zero down doesn't equal an inferior buyer like FHA. So a lot of times people think, oh, well, the veteran or the active duty service member isn't putting any money down. That doesn't mean they're qualified. That's entirely inaccurate. It's just not true. The VA buyer profile is dramatically better than conventional FHA, any other loan program. Just because you're not putting money down doesn't mean that you're not a better buyer. It's the veteran or service member's right. You've earned it. You wrote a blank check with your life to serve our country. You have the right. You've earned it. This is not something that everyone's eligible for. The VA appraisal has two additional options. So if the appraisal, one of two things will happen on the appraisal. One of three things. It'll either come in below the purchase price, it'll come in at the purchase price, or it'll come in over the purchase price. Two of the three aren't bad, right? At the purchase price or above the purchase price is great. But if it comes in below, the VA gives you two options to try to work to get the value corrected. I will honestly tell you, it's the only loan program that has that. Conventional FHA and USDA do not have this option. It's the only option where if the value doesn't come in from the appraiser, there are ways to still work to get the value properly so you can buy that home. It's one of the greatest ways to honor veterans and service members, to say thank you for your service, for a seller to participate in the home ownership dream. So one of the things that we do, if you'll see over here on the right, this letter, this pre-approval letter that I send out, it's designed to strengthen you, to let them know that you're not putting no money down because you can't. You're not putting money down because you've earned that right. And we all say we want to honor veterans. We want to honor our active duty service members. This is one of the best ways to do that. So with that being said, can you have more than one VA loan? Can you have more than one VA loan? Yes, you can have more than one VA loan at the same time. You can have a VA loan and then sell that house and use a VA loan again, and sell that house and use a VA loan again, and on and on and on. So yes, you can. There are some caveats. So let's go through that a little bit. So your basic entitlement is what happened all the way up till about 2012. Then they add what they called Tier 2 entitlement. So Tier 2 entitlement basically says they cap it out at what usually at the county median income of what your max loan amount is with no money down. Now, I will tell you that changed dramatically when that Blue Navy Sailors Bill passed in 2019. Can the loan amount be higher than the maximum loan amount determined? Yeah, it can. And I'll explain why here in a moment. So yes, let's say that there are terms where you can put money down. Just because you're not required to put money down, you may still choose to put money down to get your payments where you want them to be. Can I apply for a VA loan after a foreclosure? I get this one a lot. Foreclosure or bankruptcy. Does the VA allow if you've had a foreclosure or a bankruptcy, or are you out of the game completely? Yeah. After a 2-year waiting period, a veteran or a service member can be eligible again. Now, understand the entitlement from the loan that was foreclosed on will not be restored. So you lose part of your basic entitlement or all of your basic entitlement, and you have to use your bonus entitlement or your Tier 2 entitlement. So let's talk about, how does the VA do this, right? How do you do no money down? Like, how is it possible to have a no money down loan and no and no PMI. How do you do that, right? Like how's that possible? That's got to be way risky for the lender, right? Way risky. Well, if you're a first-time user of the VA loan, they will charge you with no money down. They will charge you 2.3% of the loan amount. So this is just a hypothetical, but say in a $500,000 loan, you're a first-time user, you would pay 2.3% or $11,500. Here's the cool thing. That $11,500 gets added on top. So if you had a $500,000 purchase, a $500,000 purchase price and loan, your loan size would actually be $511,500. That's how your loan size, right? 100% plus. Here's the plus, the funding fee, right? The funding fee right here. Now, if you've used your VA fund previously, they will make you pay 3.6% of the loan amount. So say you had a loan 10 years ago and you're using your VA loan again. Well, now they're going to charge 3.6%. So what does that look like? That looks like on the same $500,000 loan, it would be $18,000, but your loan size would be $518,000. You finance that funding fee in the transaction. This funding fee is effectively the way the VA keeps the indemnity of the program solvent. Now, funding fees are waived. If you have any service-connected disability, which is 10% or greater, you do not have to pay the funding fee at all. Whether it's the first time, second time, 100th time, you never have to pay the funding fee. If you're at least a 10% service-connected veteran or you're a Purple Heart recipient. If you're either of those, you will never have to pay a funding fee or won't have to pay a funding fee once you receive that. Now, if you've applied, if you've already started that application for disability, and then your loan goes through before you've completed that process, they will refund that to you. The Veterans Administration will refund that funding fee to you. Okay, joint loans. This comes up quite a bit. What is a joint loan? So a joint loan is a loan other than a veteran and a spouse. So let's say it's a veteran and a girlfriend, or a veteran and a boyfriend, or a veteran and a fiance, veteran and a brother, veteran and a parent. That's considered a joint loan. If there are two veterans on the loan, that is not considered a joint loan. So if it's a married couple, not a joint loan. If it's two veterans, it's not a joint loan. All right. So sometimes I'll get a call, and a service member will call up and say, "Hey, Travis, we're thinking about buying a house, my girlfriend and I. Can you still do it?" The answer is you can, but you have to have it authorized by the regional lending center. So if you're in Tennessee, for instance, that's in Atlanta. If you're in Kentucky, it's in Virginia. If you're in Florida, it's in Tampa. So just know that every state has a regional lending center that they work out of, and that regional loan center has to prior approve it, and that's done to protect the service member or the veteran, to make sure that they're not being taken advantage of. There would be a down payment required on a joint loan. So let's say it's you and your boyfriend. Okay, you and your boyfriend are buying a house. Let's do easy math. $100,000 house. I wish that still existed. It doesn't, but let's just say that it did. 100,000. The VA guarantees 25%, effectively like mortgage insurance, right? It's 25%. So if something were to happen and you couldn't pay that loan back, the VA guarantees that they're going to make it whole. Like they're going to pay it in full and make the lender whole. But in this case, the VA guarantees 25%. So if you're buying a $100,000 house, you each own half, 50-50, right? So the veteran or service member would get $50,000. They'd get 100%. The joint person, right, the person who's not the veteran, they would be required to put 25% down of their portion. So on $100,000, it would be roughly $12,500. Do joint loans always make sense? They don't. Not always. They can. They don't always. Now, there are some caveats. So let's talk about that. A veteran and a fiance who intend to get married prior to closing will not be treated as a joint loan. So meaning you're engaged and say your wedding is August 5th and you're closing on your loan August 8th. Well, then that's not considered a joint loan, right? You're married prior to the consummation of the loan. So it would not be considered a joint loan and it would be treated like a regular VA mortgage. So here are the caveats on joint loans. Let's say the non-military member, either the non-service member or the non-veteran, has a ton of income, good credit, and the veteran or service member's credit isn't so good and they have very little income. The co-borrower or the joint member of the application, their income can't offset that. They can't be used as the primary wage earner. It can cause issues. Um, Now, this isn't hard and fast. These rules do change. Any borrower on a joint loan who does not use entitlements, such as a non-veteran, does not have to intend to occupy. So, say it's the service member and a parent. The parent isn't expected to move in and live in the home. Because on VA mortgages, you are required to be an owner occupant. You have to occupy the property. Okay, so here we're going to get into occupancy. So the veteran must certify that he or she will occupy the home within 60 days of closing. There are caveats, obviously, for active duty service members who are deployed or reservists who are deployed. So the veteran certifies that he or she will personally occupy the property as his or her home at the specific date and time of closing. And, and there's a particular future event that will make it possible for the veteran to personally occupy the property home within a specific future date. So as long as it's within 6 months, you should be fine. Now, occupancy by a spouse or a dependent child. So say the service member is deployed, their spouse or their minor children basically account for the occupancy. They guarantee the occupancy. Now, that's an important piece to understand as long as it's done within a reasonable period of time. You can also apply for an extended period of time, but we have to do that. So, like if your job has you further away for a period of time, but you are expected within 1 year to be living in that home as your primary residence. If you're enjoying this presentation so far, I'm going to ask you to pull up your phone, take a picture of this, and give and go here. And I'd really appreciate a 5-star review. That really helps me grow my business. So thank you for those of you that are doing that. Okay. So what type of loan products does the VA offer? Well, the VA offers your traditional 30, 20, and 15-year loans. They offer cash out refinances. So effectively, as home prices have gone up, you could effectively refinance your home and take out the full equity minus costs, your closing costs, to do the loan. Understand that interest rate is going to be higher than it would if it was 90% or less on a cash out refinance specifically. Can you do just what they call an interest rate reduction refinance loan? We call them IRRL. That's the IC name, IRRRL, 3 R's. Interest rate reduction refinance loan. It's a streamline, basically means that the documentation is way reduced. There's no appraisal needed. You're not taking cash out, though. You're basically just reducing your interest rate or your term or both, or you're coming from an adjustable rate to a fixed rate. Those type of products, a VA loan to start with, you're turning it into another VA loan, and we're doing it to reduce your interest rate. And then there's the VA renovation loan. Now, I will tell you, this product comes and goes. There are less lenders that do this product, more coming back. But after COVID, during the COVID time, this program basically went away. There was no one willing to do it. But effectively know that your interest rate is going to be slightly higher, and you have to have a bonded, insured, licensed contractor do it. So you can't self general contract. You have to go through the process. This is not one of the best options the VA has, but it is an option. You do have it. So why do lenders want to do VA loans more than conventional loans? Why would they want to do that? So let's talk about it. The big thing lenders are always worried about they're always worried about the default. Will a loan default? So if the loan defaults, are they going to get their money back? That's the big concern. It always has been and likely always will be. So let's talk about why would a lender want that. So let's talk about the default performance. So what is it about these? So In an ideal world, you want to be at 2.5 to 3%. So, regardless of what's happening in the economy, there are always foreclosures. Always. In good markets, it's between 2.5%, right? That's ideally where Fannie Mae, Freddie Mac, the Ginnie Mae, all the portfolios, they want to stay at about 2% or less. That's in a perfect world. The VA has by far the best portfolio. Their default rate is less than 1%, 0.63%. That's exceptional, right? That's really, really good. And it's why lenders want that product. Now, on conventional loans, your Fannie Mae, your Freddie Mac style mortgages, they're at 3%. So as of 2022, which is the last time this data has been compiled, now we will start getting that data in this quarter. Uh, they're at about 3%. And then FHA is poor. They're over 8%. So you could see why the risk on that particular product is much greater. Now, that doesn't even talk about the protection for the lender. So Fannie Mae and Freddie Mac are conventional. They have no protection. Now, they make you buy private mortgage insurance to offset the risk, right? So if you're not putting 20% down, you're required to buy private mortgage insurance through one of the companies that they agree to. And then if you default, that insurance comes in and covers it. But the institutions themselves don't cover it. Ginnie Mae, which is the bond program for government loans, FHA, there's a possible payout. There's a whole kinds of procedure to go through, but there's potentially a payout. On the VA, on the Ginnie Mae portfolio, VA, it's guaranteed coverage. They won't lose a penny. Why is that important? Well, it's super important because if you understand why lenders lend money, they want their money back, right? They don't want to risk that money. They're collateralizing it with a home. The more risk they have, the higher the interest rate, which is why VA interest rates tend to be a better interest rate. Oh my goodness, what's going on here? Okay. All right, forgive me. I don't know what happened there. Let's go here. Okay. Well, that sucked. What the hell happened? Huh, that's no good. What happened to this? Let me minimize this. And let's see if we can't figure out what's going on here. What is happening? Let's try to X out of it, and then we'll try to find a better option. I apologize to you guys. Let's find the better option here. So I'm going to stop sharing my screen for a second and try to get this technology at its finest. Let's see if I can't figure out how to get this back up and working the way we want it to. So I apologize. Technology being what technology is, we always want to make sure that we're doing the right thing. So let's go here. See if we can't get this thing to fire back up. Never had a PowerPoint do that before, so that's fun. All right, here we go. So let's get back to where we were. All right, let me get this thing all dialed back to where we were. All right, and we're back at it. Here we go. Apologize for the interruption. So once again, this is why the low default rate and the guaranteed payment is exactly why borrowers and lenders love the VA loan program. So next question. Does the VA have a minimum credit score? Minimum. Now, if you look online, there's all kinds of answers to this question. The answer is very simple. The answer is no, absolutely not. The VA, the Veterans Administration, the Department of Veterans Affairs, does not have a minimum credit score for a VA loan. Now, you may be saying, Travis, but that's not what I heard. I talked to a lender and they said their score is 620 or 580 or 640 was their number. Lenders have what they call the ability to do overlays. So the Veterans Administration sets a minimum standard. They do allow lenders to set additional standards so the lender can protect their risk, right? So every lender sets their own risk tolerance. The VA sets the minimum standard. Each lender can go above and beyond that. So, what are some of the common overlays? One of the common overlays is the score. There are several lenders in the marketplace that have a minimum 620 credit score. So if you don't have a credit score of 620 or higher, when we pull your credit, we're going to pull the three major credit bureaus. We're going to drop your high score. We're going to drop your low score. We're going to use your middle. And if all the borrowers' credit scores aren't over 620, that would be for that particular lender an overlay. Please know that if you hear your lender say, the VA has a minimum FICO score or minimum credit score, the answer is that's not true. And they're either not telling you the truth or they don't know. Okay. Some of the others. So, like I said, if you have a foreclosure or bankruptcy, you are eligible after 2 years. But a lender could add additional. They could say 3 years or 4 years. I've seen lenders do that. And then there are overlays for types of property. So you can pretty much buy anything with the VA mortgage other than like a mixed use property where it's a business and then a apartment with it. That they typically don't do. There are some exceptions, and we would have to discuss that ahead of time. But they'll pretty much finance anything. Some lenders won't, right? So I have lenders that will do VA on condos. I have lenders that will do VA on mobile homes. I have lenders that will do, you name a product, barn dominiums. I have lenders that will do all of those things. So know that property type with the VA, they don't restrict it per se, but a lender could add that overlay. Okay. So will the VA allow you to finance your closing costs, right? So we talked about down payment, no down payment, right? But what about closing costs? Things like appraisal, title, doc prep, title insurance, deed stamps, mortgage stamps, recording fees, escrows. What about all of those things? All those costs. Will the VA let you put those in the loan itself? And the answer is no, but no with a caveat, no with an asterisk, if you will. So the VA in and of itself will not allow you to add the closing cost on top of the funding fee, meaning you can't go loan amount, funding fee, and then closing costs. They won't let you do that. But you can negotiate for the seller to pay your closing costs. So effectively what you're doing is you're bumping the purchase price to cover those costs, and then the seller gives you the credit to pay those closing costs for you. Here's the caveat. The market will dictate whether or not this can be done. So let me give you for instance. I'm in Clarksville, Tennessee, right by Fort Campbell. In 2020, 2020, 2021 during COVID and the houses were moving so fast, sellers were not willing to pay closing costs for buyers. Just wasn't a thing. You couldn't do it. People were paying over the asking price without asking for that. So just know that the market will dictate that. Once again, that's why who you work with is so important, because that's why having a great agent will tell you, hey, there's no way we're going to be able to do that on this home is critically important. Okay. So what are the next steps? You've gone through, you understand, okay, am I eligible? What does it look like? Do I have my certificate of eligibility? You got a pre-approval letter from your lender, all of the good things, right? You're good. So now what's the next step? So let's talk about it. I always say get pre-approved first. So if you take out your phone and hit this QR code here, this will actually take you right to the application if you're ready to start this process now. There's no expectation, but if that's something you'd love to do, I'd be honored to serve you. But no matter who you talk to, your agent is going to want you to get pre-approved. They're going to want to make sure the houses they're showing you are homes that you can actually buy. Why is that a big deal? I'll tell you why it's a big deal. You go find your dream home at $500,000 and you can only afford $400,000. There's a huge difference in home. A $500,000 house is going to have amenities that a $400,000 house does not. There's no way for them to exceed your expectations if you're trying to fit a $500,000 house into a $400,000 price range. You're going to be disappointed. The realtor is going to be disappointed. I'm going to be disappointed. We're all going to be disappointed. So we want to make sure that we know where your budget is. We want to make sure that you have an agent or a realtor who will work and negotiate for your best interest. This is critically important. Like I said, probably more important than your lender. And I know I'm a lender, right? But they are so critically important in this process. You need to go look for your home. You need to start that process. So you're pre-approved, right? You've got that. You found a great realtor to work with. I can certainly help you with that. And then now you've got to go searching. Please know there right now are more buyers than, even at the higher interest rates, there are more buyers than houses. It's better today than it was a year ago. But what I'm telling you is be patient. Really try to figure out what do you need, what do you want, and kind of give yourself some leg room there, right? Don't expect the first house you walk in you're going to fall in love with. You might, and it'd be a blessing if you did, but it's certainly not shouldn't be an expectation. You're going to write an offer with the realtor, right? So you're going to sit down and you're going to negotiate. Now, I tell this to everyone. Everything is negotiable. Everything. So talk to your realtor and figure out what the best things to negotiate are. Okay. And then ask if the seller will pay the closing costs, right? So going back to that slide before, can you finance your closing costs? The answer is technically no, but you can ask the seller to pay for it. Once again, talk to your realtor. I am seeing in the market, there are realtors that are putting in on the property, hey, we're willing to pay closing costs up to X dollar amount. That's good to know. Just because they put it in there, though, doesn't mean that's the top. You could ask for more if you'd like. Just know that as you do that, you weaken your offer, right? So your offer to purchase becomes weaker. Now, you've put your offer in. Don't expect that the first offer they're going to accept. They may, but don't expect it. If they counter back, that you're negotiating, right? Back and forth, you're going to negotiate back and forth. And I see people sometimes get really wrapped up here. They get stuck here. They decide, well, I'm not going to pay more than X amount of money. And the seller says, well, I'm not going to sell for more than X amount of money. And there's a gap. Let's have a conversation when we get to that point. Don't just throw your hands up and walk away. You may find that the difference is nominal and is worth considering. So I can't tell you how many times I've had couples sit down and we go through the process. They've looked at 100 houses. And when we figure out the difference in payments, they go, really? That's the difference? Yeah. And they're like, okay, yeah, let's buy the house. So let's just have that dialogue. Now you're going to receive an accepted offer. You finished your negotiations back and forth. Now you have an accepted offer. What I tell everyone is now is when the time ramps up, because now the clock starts ticking. Why we did the pre-approval up first, the first piece of it was get pre-approved. 80% of that's done now, right? So you're ready to go. We will have to update bank statements and pay stubs and those type of things. But now we start rocking and rolling, right? So we start the loan process. That has to be completed within a certain amount of time by law and by statute and by lender requirements. So things are going to ramp and move fast. So be prepared. You're going to have to do documentation quickly. You're going to have inspections done quickly. You're going to have appraisals done and all of those type of things. But realistically, within 30 to 45 days, you'll be moving into your new home, assuming all goes well. Now, I tell everyone, I'm the pilot of the plane, right? So we're going to be flying. Does that mean I can guarantee we'll never have any turbulence? No, I can't. But I'm going to do my darndest to steer us around it. And that's why who you work with is so important, right? So going back to that. So here is the QR code. If you want to take a picture of this, this is my contact information. You could take a picture of this, save it onto your phone, know that I'm here for you. You can ask me any questions. You can ask me anything anything that comes up or something I didn't cover that you'd like more information on. By all means, reach back out to me. Once again, the VA loan is a loan other buyers can only dream of obtaining. You've earned this right by serving our country, and it's my job to facilitate your dream of homeownership. Please know I take that very seriously. The Marine in me takes that very, very seriously. So thank you for your time. I'm at about 52 minutes. I just want to kind of reach out to you and just see any questions or concerns. I'll open it up. If there aren't, then I will move forward from there. So let me just check here in my private chats and just see what I've got in here. Okay. Okay, that's a great question, actually. So the question that was just asked is, do I have to have a home inspection? And the answer is no, it's not required. It's not required. The VA does not require you to have your home inspected. The VA on the appraisal will make the appraiser make some observations, but understand that that's not done for you. That's done for the VA. That's done for the lender, right? So sometimes people say, well, that's an inspection. It is, but understand that most inspections are encouraged for you to get your own inspector who works for you, who gives you a much more in-depth review of the home than, say, the VA appraiser will do. But it's not a requirement. It is just highly, highly, highly recommended. I would never advise someone to buy a home without getting a home inspection. Just me. So great question. Thank you for that. Okay, great question. Here's a question about interest rates. Someone is asking, where are the rates currently? It really just depends. So understand that just like in conventional lending, the higher your credit score, the better your interest rate. Now the VA has much lower tiers, right? So conventionally it's 740 and above is your top tier, then 720, 700, 680, then it goes down to 620. If you don't have a 620 score, you're not even eligible for conventional financing. And so they break out in 20s. It's vastly different than that. If you have really high credit, you're going to get by far the best interest rates. I will tell you, I'm a mortgage broker, which I love being. And what a broker does differently than, say, a traditional lender is we shop all the best lenders at the same time. So when we do your pre-approval, it might be lender A. And then when you get the contract, it might accept an offer on your contract. It might be credit union C that's got the best option, and that's who we're going to go with. So we're always going to be looking to get you the best interest rate. There are strengths and weaknesses to all different lending types, banks, credit unions, mortgage banking firms, and mortgage brokers. They all have their strengths and their weaknesses. We just find that it tends to be dramatically cheaper from an interest rate and from a fee perspective to work with a broker. So thank you for the question. It looks like that's all the questions I have. I don't see any others. Thank you so much for attending. Appreciate you. I will be doing a very similar presentation in 2 weeks. So if you know a veteran, if you know of a service member who's looking to buy, I would certainly love to have a conversation with them. Thanks so much. Appreciate you. Have a blessed day.